How much do customers owe this company? Yeah, $385.6 million. And where did you find that? Yeah, that's accounts receivable. And for inventories, $965.8 million is it acquisition cost or current market value? I bet you didn't think that I would fit so many different things, so many answers to the questions. I've gone over almost all this stuff. Believe it or not, between today and last time, I'm very proud of myself. I've gone over all this, but let's go over it again so we know it. PP&E net is I didn't really go over. $2,355 million is the acquisition cost. Current market value, book value, can't tell. It's really the book value. What it is, and this I didn't go over, it's the acquisition cost. I touched on it last time. It's acquisition cost minus the depreciation is what it is, and that's called book value. What amount of investments does this company intend to hold for more than 1 year? And I'm just going to write this here so you have it. Acquisition cost. What amount of investments does this company intend to hold for more than 1 year? Yeah, $479.3 million. And what is that? That is on the balance sheet. It's listed as item long-term investments. What's created when the company is acquired? I mentioned this last time. Goodwill. Is created when a company is acquired. How much does this company owe to its suppliers? How much? $540 million. And that was called what on the balance sheet? Current assets total what? $3,794.9. And in case you're wondering where that came from, that is all of these items here added up. So it's the first 5 items, all current assets. Current liabilities totals what? $2,075.8 million. And that would be all these items add up. The first 3 liabilities. Now, current assets are used to pay off what? I didn't tell you this last time. Current liabilities, that's really the relationship there. There's a natural relationship between current assets and current liabilities. And the thinking is the current assets should pay off the current liabilities. And the company, does it have enough current assets to pay off its current liabilities? Yeah, it's $3.7 billion in current assets, only $2 billion in current liabilities. So the company has sufficient current assets to pay off its current liabilities. Non-current assets total what? $3,565.5 million. And again, if you're wondering where I got that, that would be these items right here. And non-current liabilities are these items over here. And they add up to how much? 899.7. And this is interesting. Non-current liabilities are used to finance what? Non-current assets. So the idea is that if you need a building, what do? You take out a long-term loan. Take out a mortgage, and that would be a non-current liability. So the building is a non-current asset, and the mortgage is a non-current liability. Contributed capital represents amounts paid in by shareholders. You remember that from last week. The company is relying primarily on what to finance its assets? This is the hardest question here. Retained earnings. Why do you say retained earnings? Yeah, because retained earnings is the big number over here. Here you go. There's retained earnings. This is obviously the biggest number on the right side, indicating that it seems like most of their equity, most of their financing is coming through here. How else would this appear? Well, you could have high contributed capital like in a startup, or you could have very high debt like if for Ford. So Ford would have very high long-term liabilities. Because it had, remember, Ford had 101% of its assets and liabilities. So Ford is all long-term debt. Whereas this particular company, all the funding seems to be coming through retained earnings. What does that mean when they funded their operations through retained earnings? What does it mean on a practical level?
Let's not rely on stockholders.
They don't rely on stockholders?
Coming from their net income instead of paying dividends.
Yeah. It's coming from their profits. They're reinvesting their profits into the business. Rather than paying it as dividends, they reinvest the profits as business, and that's what retained earnings is. The balance sheet reports a company's financial position as of its certain date or over a period of time. Yeah, and it's important to let me just touch on this one more time. The balance sheet is as of a point in time, like December 31st midnight, but the income statement, the statement of stockholders' equity, and the statement of cash flows are over a period of time, usually a year. Yeah?
Finance, the second part of debt.
Oh, okay. Retained earnings. Would you call that external or internal source of financing? What? Well, let's go through each one. Long-term debt, is that internal or external? That's external because you're borrowing it from other people. Let's just mark this down here. Contributed capital is external also because it's coming from your stockholders. Retained earnings is internal because you're just taking your profits and you're putting it back into the business. This we didn't go over, but you may have seen it before. Assets and liabilities recorded on the balance sheet in order of liquidity. What does that mean? What is liquidity? Yeah, David?
Isn't that just cash, like for cash?
Well, cash is liquid.
What you can get, how fast you can turn into.
How quickly you can turn something into cash. That's the idea of liquidity. So cash has the ultimate liquidity because it's cash, right? On the other hand, accounts receivable, how do you convert accounts receivable into cash? You have to collect the money. How do you convert inventory into cash? By selling it. How do you convert PP&E into cash? You have to sell it, right? But we don't plan to sell it anytime soon. How about goodwill? How would you convert, let's just move down the balance sheet, right? All the way at the bottom is goodwill. How would you convert goodwill into cash? You have to sell the whole company. So you can see that at the very top of the balance sheet over here, these items are highly liquid, whereas these items down here are very illiquid. Now, the liabilities are the same way. Accounts receivable are the liabilities that we have to pay earliest, and long-term debt and other are the things that we have the most time to pay. US GAAP and IFRS, which means that cash will always be reported before PP&E. By the way, in Europe, they do it in the opposite direction. I don't know why, but they put the most liquid assets at the bottom of the balance sheet. The balance sheet is completely upside down in Europe. You would expect that like in Australia or someplace, but not in Europe. And they, yeah, and since we've been here a while, we might as well start getting to corny jokes. So PepsiCo, right? Even though the inventory itself is liquid, it still goes beneath cash. Never mind. It's lame. PepsiCo. What is PepsiCo's inventory?
Like soda.
Soft drinks, right? How liquid is that?
It's water.
It's very liquid, right? It's water, but it still goes below cash. US GAAP and IFRS, all right, so this I didn't talk about. US GAAP and IFRS treat cash the same, but different for PP&E. Because in US GAAP, PP&E is valued at cost, whereas in IFRS, you can actually revalue your PP&E at fair value. It's something maybe I should tell you or not, I don't know. But so in Europe, what you can actually do is, and this is why one reason why European accounting is so screwed up, is you can actually use a fair value option for PP&E. You can revalue all your PP&E at fair value. If you just want to like write up your balance sheet or something. All right, next.